My perspective is as a due diligence practitioner, so I represent investors who are conducting operational diligence on managers and determining whether their infrastructures are sufficiently adequate to safeguard assets and meet their operational expectations. And I think I'd really reinforce Shankar's original comment with respect to terminology and equally the different business models. Personally, I think that shadow accounting is actually quite an unhelpful phraseology and is something of a misnomer. If I sort of think about this in context, I really see two core elements to the accounting process, being fund accounting and portfolio accounting. So fund accounting is actually creating the NAV, and that ultimately, as an investor, is what I'm concerned with. I don't own the management company. I don't own the individual securities within the portfolio. I own shares in a Caymanian corporation or limited partnership interests in a Delaware LP. That is my actual investment. And I need a net asset value calculation only to do two things. First of all, to be the value at which I subscribe or redeem from the fund, and secondly, as the denominator for the fees that I pay to the manager as the service provider that that fund is appointed. So that is fundamentally an end-of-month process, assuming a monthly subscription and redemption cycle, although, of course, as we look to more retail liquid alts, that is now becoming a little bit more frequent. But if we go back a few years, and whether funds were self-administered here in the States or were relying on administrators in Europe and elsewhere, the traditional model always was that we have the fund admin calculating the NAV, and there's quite a degree of independent watchdog element to that to be protective to my interests as a shareholder and an investor. And that's quite separate from the portfolio accounting requirements that are required to allow the investment manager to run their business. And that's the T+0, T+1 process of trade capture, confirmation, settlement, reconciliation, reporting. That's driving risk. That's fundamentally driving the information that portfolio manager sees on his or her desk as they're making the next investment decision. Traditionally, fund admins didn't do that, as Shankar just alluded to. And over time, fund admins have now moved and migrated their businesses, so that is an additional service that can be added to the process. So the question of shadow accounting arises only if, first of all, the investment manager has elected to rely primarily on an administration company, not only to calculate the NAV, but also to be the primary books and records of the portfolio that drive the investment decision-making process. So the question then comes, if you are relying on the administrator, the traditional admin for some or all of that, do you need to keep separate records in-house to provide oversight, to provide a second level of check, and to provide more flexibility around data? Certainly as an investor, I'm a traditional accountant's accountant. I like to see a tripartite reconciliation. I like to see things being done in both situations. So I certainly see the issue of having an administrator externally and then having internal books and records as being a very important part of the process. And whether those internal records are maintained by an in-house group of back office accountants with Advent Geneva or are outsourced to a shadow accounting firm such as Vitios, to use the terminology, that's an alternate business model, but there is still a separation between what my traditional admin is doing and what my investment management company is doing.